All right, good afternoon, everybody. This is Jed Manuel with Manual Mortgage. Today, I wanted to record this video and show you how to purchase a home or another way to purchase a home. With rates still rising, of course, we've gotten a little bit of relief, and as well as home prices still going up. Now, it's not going up as quickly as they used to. However, home prices are still going up, and we're not in a declining market. So what I wanted to do, is show you how to purchase a home a different way to help increase affordability. With these two components that I mentioned, with rates going up and property values still increasing, buyers are experiencing or have been experiencing what they call sticker shock. So payments have gone up, prices going up, and so I wanted to address that in this video. So this video is actually based on a builder. So it's going to be new construction. And most developments actually, they have discounts to where they will take off 10, 20, 30, 40, $50,000 depending on the builder in the neighborhood, and of course the size of the purchase, size of the home. So this one's not based on any kind of builder in particular. And so let me share my screen so you can see what I've actually got to be working on. So here you can see what I call as a total cost analysis. I'm trying to show you here the title of how to buy a home, or a different way to purchase a house so the home is more affordable. So this home is actually based on a $300,000 purchase and 5% down payment. We're going to have a buyer or a hypothetical buyer that has a 740 credit score. Here you can see 5% down payment, 285 is the loan amount, and the going interest rate today is going to be 4.125%. No points, no fees for that rate. And here you can see the total monthly payment, all-in monthly payment with taxes and insurance and mortgage insurance, because you're putting down less than 20%, is going to be $2,357. Now, the cash to close that you see right here at $21,691, that does include your 5% down payment, as well as any other closing costs that you'd be responsible for at the time of closing. So in column number 2, this is where the builder is going to come in with for example, a $12,000 discount. So very simply, they just take $12,000, subtract that from the previous list price. Now you have a new sales price of $288,000. Now compare apples to apples, got the same interest rate at 4.125%. And here now you can see the total all-in monthly payment is $2266. Now by reducing the sales price $12,000, the buyer is now saving $90 a month. It's a pretty good savings, but it might seem a lot more to you at the time you signed that contract. But here's why we developed column number 2. We developed column number 2 so we can show you a better way or a different way for, to accomplish what you want and to have this home a little bit more affordable. Now in column number 2, we're going to take that same $12,000 and apply it to my product, the SVD Advantage. We start using that $12,000, and here's where we can see the magic happening. We're right back at the original list price of $300,000. Take a portion of that $12,000 and apply it to buy down the interest rate. And so here you can see where that magic's beginning to happen here at a lower 3.625% interest rate. And now we're going to use the rest of that money to buy out your mortgage insurance. So this loan has a lower interest rate for the rate sensitive buyer, as well as that buyer that believes that they had to put down 20% to alleviate the mortgage insurance. So there's no mortgage insurance on this loan. And now you can see the total monthly payment is going to be $2,149. So if we compare that to column number 2, it's a $207 difference per month. And we compare it to column number 2, you're going to see here that the payment using the same $12,000 in a price reduction is going to be $117 less. Now, keep in mind, it has a lower interest rate for that rate sensitive buyer, and there's no mortgage insurance. So that $150 a month that's on this mortgage insurance is not going, it's not just being wasted and going to nowhere. It's not going to a bucket that doesn't benefit you in any way. So here you can see the big difference in using that same amount of money instead of going to a price reduction and use it toward your advantage. And so just to give you an idea of or where you would actually select if you before you chose to put that $12,000, I got column number 4 here. So you would actually need to do a price reduction of $27,250 just to have that same financial impact and savings as that column number 3, where we use that $12,000 to my Advantage product. Now, when you take a look at that, you can also, what I have it down here, if you use the $12,000 in a price reduction, here you can say over a 6-month period, 5-year period, I should say, you're saving $2,500 per over that 5-year term. If we use that same $12,000 and apply it to the product in column number 3, you can see that savings over 5 years is going to be $14,000. That's no longer apples to apples. It's apples to oranges from the payment, the interest rate, and the mortgage insurance, and the savings over a 5-year period. Now, in this example I have as well here you can see the payment differences. Is going to be the savings that you'd have over a 10-year period. Now, most buyers or homeowners would stay on average in a home between 5 and 10 years, which is why I have this 10-year period here. Most buyers or homeowners, I should say, aren't going to stay in that home for more than 30 years. Aren't going to stay up to that home in 30 years, I should say. Our parents used to do that, but these days, that doesn't happen quite as often. And so, but if you do, this probably isn't going to be the loan for you. You're going to want to go with that lower, house payment, the lower sales price, but it really depends on what you're looking to do. And this is why I have these different scenarios, so you can easily choose which option is going to, best fit your needs, in the moment. So here you can see over the 10-year period, the MI and interest over that 10 years is so much lower. If you go with the $12,000 in the price reduction compared to the $12,000 in the seller buy down Advantage, you can see that once again, it's coming out on top by say $24,000, $22,000, over $20,000 here. So you can see that by far in this scenario where you should allocate that $12,000 so this home is more affordable for you in the short term and the long term. I hope this information helps and gives you a better idea of how to position yourself to purchase a home. Negotiating doesn't begin at the time of that contract. Negotiating actually should begin at the point of getting your pre-approval. So the lender and the agent can work together. That way they know how to plan out negotiating that contract for you with the builder, or even with a listing, a pre-sale on a home. So I hope this helps you once again. If you have any questions, give us a call. I'll be happy to work a scenario for you that's based on your credit score and your qualifications to meet your financial needs in the moment. Thank you very much, and we look forward to hearing from you.